Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Welcome, everyone. This is Steve Meisinger, your host for today's ISE webinar. Today we have Mark Sebastian with us. Mark's a former market maker on the CBOE and the Amex, and he's a director of risk for a private hedge fund, and he'll be talking about skewness, how we can understand skew. He'll be using live vol to teach us more about skew and how we can effectively trade options using this skew technique. Mark, thanks for joining us today. Really appreciate it.
Oh, thanks for having me, Steve. I'm excited to be here. Well,
it's awesome. Why don't you share your? I'm going to share that you could share your desktop, I should say. I'm just going to give you control, and we're ready to go.
All right, sounds good. I'm somewhat familiar with WebEx, so I need to click the Share Desktop. And all right, everybody. I wanted to thank Steve and the ISC for having me. It's interesting giving a presentation for the exchange that ruined my former job. And they made it much better for customers, but what they did was they kind of brought a lot of efficiencies to the market that just would never have been there if it wasn't for the ISC and them forcing electronic trading down reluctant throats. And it's a good thing for customers, bad thing for market makers, but you know what? In the end, there's a lot more customers than there are market makers, and I think the net effect was probably a positive for the world. At least that's what the ICE would say, right? Exactly,
Mark.
So,
and I'm a former Amex market maker also, so I had to sort of go with the flow. Years ago.
When did you leave the 10 years ago? So like 2000 was about when you popped away, or 99?
Actually, I was on the New York floor, the Amex floor. I was in Philadelphia from 97 through 2002.
Oh, okay, gotcha.
I was in the Amex in the 80s and the early 90s.
Beautiful times they were. Beautiful times. I was in grade school in the 80s and the 90s.
Lucky you. Lucky you.
All right. What we're going to talk today is about volatility skew and the FX. Are they friends? And obviously, the lion and the lamb lying together. Many say that can't happen, and here clearly it can. And my opinion is that for the FX trader, they're not just friends. They're something that you absolutely have to understand if you're going to be trading options, because that is where you're going to get your edges, trading these skews, trading these different spreads off of one another. Okay? So what are you going to learn today? All right? How does volatility move within a term? And when I say a term, I mean a contract month. As professional traders will use terms we'll use words like term structure and term and all sorts of different types of things. A term is obvious. Term structure is just how the different months are laid out in volatility, how their volatilities are laid out relative to one another. All right. Then we're going to talk about what relationships exist between expiration months, terms, what relationship exists between the terms, and then are there trades that one can enter to take advantage of movement in implied volatility? Obviously, I wouldn't be here if the answer was no. And then finally, I'll answer, where will the U.S. dollar be trading in 6 months relative to all the major world currencies? I'm going to tell you exactly where we'll be. And I think that's something that, it's probably the least important part of the presentation, but it's something that I thought I threw in. And by the way, if you really think that this is going to be a part of the presentation, then I've got some. What was the I've got some real estate in Arkansas that they set in during Whitewater. Wasn't that the joke?
That was, Mark.
So obviously, if I knew this, I wouldn't be here. I'd be living, me and Steve and our families would be living on our island, because I'd let you in on that, Steve. We'd call it, yeah, we could call it Sebastian Island, or Metzenschen. That would be good too. So. So we'd be living on our island. I wouldn't be here giving this presentation. So, all right, volatility. All right, we all know that volatility over the life of the option is the only factor in the model that really isn't quantifiable right now. Okay, if you don't really know what's going into an option model, don't trade it. Okay, I mean it. If you don't understand how options are structured, how they work, what drives them, then, turn off this webinar, go to your local library, pick up my friend Shelley Natenberg's book, pick up my friend Mark Wolfinger's book, pick up Jim Bittman's book, pick up, any type of book and start reading, because you've got a lot to learn before I would ever suggest that you trade. But when I say quantifiable, what do I mean by that? Well, we've got stock price, stock price, or in this case, exchange rate. I think that's pretty easy to figure out, okay? Time to expiration. Again, I think we can all figure out when that FX option is going to expire. Then we've got kind of a carrying cost. Then we have the strike price. Again, all these things, carrying costs can get a little tricky sometimes, but for the most part, it's definitely something if you sit down and work on, you can figure out. Okay, and then you've got obviously the strike price. Now, if you can't figure out what the strike price is, again, it's pretty simple. Just kind of look at your screen. Now, with options, we're trading volatility. Okay, that's the only thing we really don't understand. What should that option really be priced? Okay, the truth of the matter is we don't know. Okay, so the best we can do is to try and guess, and that's where the term implied volatility comes from. All right, and you'll see different educators, different trainers come in here and talk about volatility, and they'll say, well, volatility goes up if vol goes down, if vol goes up if vol goes down. Well, here's the part where a lot of those guys leave off. And my theory on this, I never could exactly figure out, but there's myself, and I want to say one or two other guys out there that kind of teach this stuff. But my theory is that the majority of the guys that are out there educating came off the floor before it went fully electronic, and you had to know this stuff cold. Otherwise, you would get literally picked off electronically. So that's something that you really do need to know nowadays. All right. So what many don't understand is that volatility is really non-uniform. Okay. It's more like a wave. It's connected but not correlated. If you look at a wave, okay, every part of the wave is kind of moving at differing rates, and the wave is changing shape depending on what's going on the seafloor surface, what's swimming around in the water, what's going on with gravity. Is it low tide? Is it high tide? All of these different factors are affecting a wave, and that's similar to volatility. All right, every strike and month, they're correlated, but they're not tied at the hip. Okay, they don't necessarily move uniformly. Okay, so if you get one thing out of this presentation, if this is the only thing you got out of this presentation, I would leave satisfied. But my hope is you're going to get a lot more. Okay.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.